Credit Suisse did not collapse. It was erased. Over a single weekend in March 2023, the second largest bank in Switzerland ceased to exist. Not through bankruptcy, not through liquidation, not through any process that resembled the orderly resolution frameworks regulators claimed existed for exactly this scenario. It was absorbed, forced into a merger with UBS under terms that violated standing law, rewrote bondholder priority, and bypassed shareholder approval. The Swiss government did not ask for permission. It announced the deal as complete before markets opened Monday morning. This was not a rescue. This was containment. And containment only happens when the alternative is systemic panic. Credit Suisse was a 167-year-old institution. It had survived 2 world wars, the Great Depression, the 2008 financial crisis, and decades of regulatory overhaul designed specifically to prevent what happened in March 2023. It was designated systemically important. It was stress-tested annually. It happened anyway, and when it did, the system did not follow its own rules. It rewrote them in real time, over 48 hours, behind closed doors, with no public input and no legal recourse for the people whose wealth was redistributed by executive order. Shareholders were told their equity was worth almost nothing. Bondholders were told their claims were void. These were not market outcomes. These were administrative decisions. The Swiss government decided that certain contracts would not be honored, that the rules written after 2008 to prevent arbitrary bailouts would be suspended because enforcing them was inconvenient. The justification was financial stability. The reality was that allowing Credit Suisse to fail publicly would have exposed how fragile the entire system actually is. So it was not allowed to fail publicly, it was disappeared. This is how modern banking works, not through assets and liabilities, through perception management, through the suppression of visible collapse, through ensuring that the public never sees how close the system is to breaking at any given moment. Credit Suisse was not an outlier. It was a regulated, audited, capital-adequate bank by every official measure. Its Tier 1 capital ratio was above required minimums. Its liquidity coverage was compliant with Basel III standards. None of that mattered, because modern banking does not run on capital. It runs on confidence. And confidence, once broken, cannot be rebuilt with balance sheets. It can only be suppressed with force. The collapse began with a single sentence. On March 14, 2023, Saudi National Bank, Credit Suisse's largest shareholder, announced it would not provide additional capital. One investor saying no. That should not destroy a bank. But it did. Within hours, clients began withdrawing funds. Not billions, tens of billions. In a single day, Credit Suisse experienced outflows that would have taken weeks in a traditional bank run. This was digital panic, clients clicking buttons, wire transfers executing in seconds, wealth moving faster than regulators could react. The bank did not run out of money that day. It ran out of the appearance of stability. And in modern banking, appearance is the product. By Friday, Credit Suisse was functionally insolvent, not because its assets were worthless, because its liabilities were being called simultaneously. The bank had plenty of assets. It did not have liquid assets. And liquidity is not something you can generate when everyone is trying to leave at once. Regulators had 2 choices: let the bank open Monday and collapse publicly, or force a solution over the weekend. They chose the latter, not because it was legal, because it was necessary. UBS was told it would acquire Credit Suisse. This was not a negotiation. The price was set by regulators. $3 billion for a bank that had been valued at over $8 billion days earlier. UBS did not want the acquisition. It was compelled. The terms were worse for everyone else. Credit Suisse shareholders received 1 UBS share for every 22 Credit Suisse shares they held, a 99% loss. Bondholders holding additional Tier 1 capital instruments were told their bonds were worth zero. $17 billion of bondholder claims were voided by regulatory decree. This violated the standard hierarchy of capital structures. Equity is supposed to be erased before bonds. That is how bankruptcy works. That is how capital markets work. It did not matter. The Swiss regulator declared that under emergency powers, normal priority rules did not apply. The bonds were written down to zero. Shareholders kept something. Bondholders got nothing. Translation: the rules exist until they do not. The merger was completed by Sunday night. By Monday morning, Credit Suisse no longer existed. The Swiss National Bank provided over 100 billion francs in liquidity guarantees. The Swiss government provided a 9 billion franc backstop. This was not a free market outcome. This was a state-directed erasure of a failing institution before the public could witness the failure. If the system were resilient, Credit Suisse would have been allowed to fail through the resolution mechanisms built after 2008. Those mechanisms exist in law, they were not used, because using them would have required admitting that they do not work in practice. Credit Suisse was erased because letting it fail visibly would have revealed what the monetary system actually is. Not a network of capital-backed institutions, a confidence game that functions only as long as no one tests it too hard. Banks do not work the way people think they work. The popular understanding is that banks store money, that they hold deposits in reserve, that they lend out a portion and keep the rest accessible. This is not true. It has never been true. But the system requires people to believe it is true. Modern banks do not store wealth. They transform it. Deposits become liabilities the moment they arrive. The bank owes that money back on demand. But the bank does not keep it. It lends it. It invests it. It uses it as collateral for positions that will not mature for years. This is fractional reserve banking. And it only works if most people never ask for their money at the same time. Credit Suisse held over $500 billion in client assets. It did not hold $500 billion in cash. It held bonds, mortgages, derivatives, long-term positions that could not be sold quickly without destroying their value. The bank was solvent on paper, but solvency is not liquidity, and liquidity is what matters when clients want their money back immediately. A bank can be solvent and still collapse. If it cannot convert assets to cash fast enough to meet withdrawals, it fails. Not because it is broke, because it is slow. And in modern markets, slow is fatal. This is the core fragility of banking. The system is built on duration mismatch. Banks borrow short and lend long. They take deposits that clients can withdraw at any time and invest them in assets that take years to mature. This generates profit. It also generates structural vulnerability. The vulnerability is managed through confidence. As long as clients believe the bank is stable, they do not withdraw. The system functions not because it is sound, but because it is not tested. Credit Suisse was tested. The moment clients began withdrawing in size, the duration mismatch became visible. The bank had the assets. It did not have the cash. This created a self-fulfilling dynamic. The more clients withdrew, the more fragile the bank became. The more fragile it appeared, the more clients withdrew. This is not panic. This is rational behavior. When a bank looks unstable, leaving is the correct decision. The problem is that everyone leaving simultaneously guarantees the collapse. Banks call this a liquidity crisis. It is more accurate to call it a belief crisis. The bank did not run out of value. It ran out of the belief that value could be accessed without loss. Central banks exist to solve this problem. They are lenders of last resort. When a bank faces withdrawals it cannot meet, the central bank provides emergency funding. This stops the run. This only works if clients believe the bank is fundamentally solvent. If they believe the bank is insolvent, central bank funding does not stop the run. It just delays it. Credit Suisse received emergency liquidity from the Swiss National Bank, 50 billion francs. Then another 100 billion. The injections were announced publicly. They were meant to signal strength. They signaled desperation. Because liquidity injections carry information. They tell the market that the bank cannot fund itself, that it has lost access to private capital. This is not reassuring. It is confirming. The more support Credit Suisse received, the faster clients withdrew. The support proved the bank was in distress, and distress, once visible, accelerates. This is the paradox of banking intervention. The tools designed to stabilize banks also signal weakness. Emergency liquidity is supposed to calm markets. It often inflames them. Credit Suisse was trapped. If it did not take central bank funding, it would run out of cash. If it did take central bank funding, it confirmed it was failing. There was no option that did not reinforce the panic. The monetary system is not built on reserves. It is built on the assumption that reserves will never be needed, that clients will not withdraw en masse. That confidence will hold. When confidence breaks, reserves do not matter. Central bank liquidity does not matter. Capital ratios do not matter. What matters is whether people believe the bank will survive, and belief once lost cannot be restored with cash injections. The tipping point was not a financial metric, it was psychological. Saudi National Bank's refusal to inject more capital was a signal that a major investor had lost faith. That signal propagated faster than any regulator could respond. Modern banking runs do not happen in lines outside branches. They happen in boardrooms and trading desks. Clients move money quietly. Billions leave before anyone outside the bank realizes there is a problem. By the time regulators understood the scale of the withdrawals, the run was irreversible. Credit Suisse was losing tens of billions per day. No bank can survive that. Not because the bank is insolvent, because liquidity cannot be generated fast enough to meet the outflows. The financial system is not a vault. It is a network of promises. Promises that deposits are safe, promises that withdrawals will be honored. Those promises are not backed by cash in a vault. They are backed by belief. Belief that other people will not withdraw. Belief that the bank is managed competently. Belief that regulators will intervene if necessary. Credit Suisse lost all three forms of belief simultaneously, and a 167-year-old institution disappeared in 72 hours. The moment belief broke was visible in real time. March 14, 2023. Credit Suisse's largest shareholder was asked a simple question during an interview. Would the bank provide more capital if Credit Suisse needed it? The answer was no. Not a qualified no, just no. The statement was technically accurate. It was also fatal, because banking is not about technicalities, it is about perception. And what the market heard was not regulatory restrictions. It was the largest shareholder is refusing to support the bank. That refusal was read as a vote of no confidence. Within hours, Credit Suisse's stock price collapsed. Credit default swaps spiked to levels that implied imminent default. These are real-time measures of belief, and belief was evaporating. The bank issued a statement. Management assured clients that Credit Suisse was well capitalized and liquid, that there was no cause for concern. The statement was true. It was also irrelevant. Reassurance does not calm panic, it confirms it. Because stable institutions do not need to reassure anyone. The fact that Credit Suisse felt compelled to issue a public statement told the market that the bank was worried about perception. This is the trap of crisis communication. Silence looks like denial. Statements look like desperation. There is no message that restores confidence once it begins to crack. Credit Suisse's executives were trapped in a system where appearing uncertain is fatal. They could not admit the bank was in trouble, but they also could not pretend everything was fine when the stock price was collapsing and clients were withdrawing billions. By March 15th, the Swiss National Bank announced it would provide liquidity support to Credit Suisse, 50 billion francs available if needed. This was supposed to be a backstop. It had the opposite effect. Markets do not interpret central bank support as optional. They interpret it as necessary. If the Swiss National Bank was offering 50 billion francs, it meant credit. Suisse needed 50 billion francs. The announcement accelerated the withdrawals. Clients who had been waiting to see if the bank stabilized now had confirmation that it was in distress, not from rumors, from the central bank itself. Credit Suisse took the liquidity. It had no choice. The bank survived another day, but survival was no longer the question. The question was whether clients would stop withdrawing. They did not. By March 16th, the outflows had reached catastrophic levels, over 10 billion francs per day. Not retail depositors pulling savings, institutional clients, wealth management accounts, the sophisticated money that moves fastest and never comes back. By now, the entire market understood what was happening. Credit Suisse was experiencing a belief collapse. The fundamentals did not matter anymore. What mattered was whether clients thought other clients were leaving. And once that feedback loop starts, it cannot be stopped with press releases. Regulators saw the outflows. They knew the bank was in a death spiral. But they were reactive, and they were operating under the assumption that liquidity support would be enough. It was not enough. Every action regulators took to stabilize Credit Suisse confirmed that Credit Suisse needed stabilizing. Every liquidity injection proved the bank could not fund itself. This is what visible failure looks like, not a sudden collapse, a slow-motion unraveling where every attempt to stop the decline accelerates it. By Friday, March 17th, Credit Suisse was functionally finished. The bank was still open, still operating, still technically solvent, but belief was gone. And without belief, a bank is just a building full of liabilities it cannot meet. This is the moment the system breaks. Not when a bank runs out of money, when it runs out of time, when the pace of withdrawals exceeds the pace of intervention, when confidence collapses faster than capital can be injected. Credit Suisse was not killed by insolvency, it was killed by velocity. The speed at which belief collapsed outpaced every tool regulators had to restore it. By Sunday, March 19th, regulators made the decision. Credit Suisse would not open as an independent bank on Monday. It would be merged with UBS over the weekend. Not through negotiation, through compulsion. The decision was not financial, it was political. Allowing Credit Suisse to fail openly would expose how fast a major bank can collapse when belief breaks. It would show that all the post-2008 reforms, all the stress tests, all the capital requirements do not matter when clients decide to leave. So the bank was not allowed to fail openly. It was absorbed quietly, erased over a weekend, removed from the system before the public could see how fragile the system actually is. The moment belief broke, the bank was already gone. Everything that happened after was just managing the announcement. Credit Suisse was not a failure, it was a revelation. The collapse exposed what the global financial system actually is, not a network of stable institutions backed by capital and regulation, a belief structure that functions only when it is not examined too closely. And when it is examined, the response is not reform, it is suppression. The rules written after 2008 were supposed to prevent exactly what happened in March 2023. Banks were stress tested, capital requirements were increased, resolution frameworks were established. None of it was true. When Credit Suisse collapsed, every framework was bypassed. The resolution mechanisms were not used. The creditor hierarchy was not honored. The rules were suspended because following them would have meant allowing visible failure. And visible failure is not acceptable. This was not a mistake, it was a choice. Regulators chose to override standing law rather than let the public see a major bank collapse through the processes that were supposed to make collapse safe. The processes do not work. They never did. They were always theater. Credit Suisse's additional Tier 1 bondholders learned this in real time. These bonds were explicitly structured to absorb losses before equity. That was the deal. In bankruptcy, bonds are senior to equity. Always. Unless regulators decide otherwise. The Swiss regulator declared that AT1 bonds would be written down to zero while equity retained value. This inverted every principle of capital structure. The justification was financial stability. The reality was convenience. Writing down the bonds was faster than writing down equity. It required fewer legal steps, so the bonds were eliminated by decree. $17 billion of bondholder claims were erased, not through bankruptcy, through regulatory order. The Swiss government used emergency powers to void contracts. Contracts are enforceable until they are inconvenient. Rules exist until they are bypassed. This is not an aberration. This is how the system operates when tested. The frameworks are not binding. They are conditional. When they threaten systemic stability, they are discarded. Credit Suisse was merged with UBS under terms that UBS did not negotiate. The Swiss government informed UBS that it would complete the acquisition. UBS executives made clear they did not want the merger. They were told refusal was not an option. The price was set by regulators, $3 billion. UBS did not bid. It was assigned a price and told to accept. The entire transaction was structured by the state and imposed on the parties. This is not capitalism. This is not market discipline. This is state-directed consolidation using emergency powers to override private decision-making. And it worked. The merger was completed over a weekend. Markets opened Monday with Credit Suisse absorbed into UBS. No visible collapse, no contagion. The system held, but holding is not the same as functioning. The system held because the rules were suspended, because contracts were voided, because regulators decided that preventing panic justified any intervention. This sets a precedent that cannot be unset. Every bondholder now knows their claims are conditional. Every shareholder knows their equity can be diluted by decree. Every institution knows that in a crisis, the legal frameworks do not apply. This does not make the system more stable, it makes it more fragile. Because stability requires predictability. Investors need to know what happens in failure. Markets need to know the rules will not change mid-crisis. Credit Suisse destroyed that predictability. It proved that the rules are negotiable, that regulators will do whatever is necessary to prevent visible collapse. Credit Suisse was not a unique case. It was a test case, and the test revealed that no major bank can be allowed to fail through normal processes, because normal processes take time, and time allows panic to spread. So the system has evolved a different approach. Banks do not fail. They are absorbed quietly over weekends. With emergency powers and regulatory compulsion, the public never sees the failure. They see the announcement that it has already been managed. This is not resilience. This is concealment. The financial system is not stronger than it was in 2008. It is better at hiding weakness. And hiding weakness is not the same as eliminating it. Credit Suisse collapsed because clients lost confidence. But the same risks exist across the system. duration mismatches, liquidity dependencies, confidence-based stability. Every major bank operates on the same model. Borrow short, lend long. Rely on clients not withdrawing simultaneously. Credit Suisse proved that model breaks when tested. The response was not to fix the model. It was to ensure the model is never tested visibly again. This cannot last. Systems built on suppressed failure do not become more stable over time. They become more brittle. Banks do not learn from failure if failure is not allowed. Investors do not price risk accurately if risk is always socialized. Credit Suisse was papered over. The vulnerabilities that killed it still exist. In other banks, in other jurisdictions, in the same regulatory frameworks that failed to prevent the collapse. The monetary system is not a machine. It is a confidence game, and confidence games work until they do not. Credit Suisse stopped working in 72 hours. The response was not to question why. It was to ensure no one noticed how fast it happened. That response is not a solution. It is a delay. The system is not safer because Credit Suisse was erased quietly. It is more fragile because now everyone knows that in a real crisis, the rules do not apply, that regulators will override law to prevent visible collapse, that contracts are conditional and frameworks are temporary. This is what Credit Suisse exposed. Not that one bank failed, that the entire system is built on mechanisms that only work when they are not needed, and when they are needed, they are discarded. The belief that holds the system together is not belief in solvency. It is belief that regulators will intervene, that failures will be managed, that deposits are safe because the state will not allow them to be lost. That belief is correct. Regulators will intervene. They will override rules. They will void contracts. They will do whatever is necessary to prevent visible collapse. But intervention is not strength. It is admission of fragility. Every emergency action confirms that the system cannot survive on its own, that it requires constant management, that it is always one belief collapse away from requiring another weekend of forced mergers and suspended rules. Credit Suisse did not collapse because it was uniquely broken. It collapsed because belief broke, and belief can break anywhere. At any time, for any institution that looks even slightly unstable. The system does not run on capital. It runs on the appearance of capital, on the assumption that withdrawals will not exceed liquidity, on the belief that regulators will act before collapse becomes visible. Credit Suisse proved all of that correct, and in proving it, exposed that the system is exactly as fragile as the skeptics always claimed. The collapse was contained. The system survived. But survival through suppression is not stability. It is postponement, and what has been postponed will eventually arrive.